Hi, everyone, and welcome to this episode of Money Moves. I'll start off this episode with a quick overview of the things that I'm looking at in the markets today. Next up, it's been a very long time since I've gone over my whole portfolio, so I will do that in this episode, and I'll start off with those changes here with worthy bonds. And I'll go over Groundfloor, some of the changes I've made here in Fundrise, M1 Finance, as well as my TSP account. And of course, there will be some jelly at the end, which is something I enjoyed outside of the markets. If you have big dreams like owning this 6-bed, 8-bath mansion in Kansas City, Missouri, or if you're just getting started on your financial journey, definitely like and subscribe. I like to look at houses like this because sometimes you're like, wow, that looks amazing. And other times you're like, wow, that looks terrible. Pick that carpet. Change that out. Overall, it's still pretty nice. I don't know if it's worth $4 million, though. That's pretty steep. But at least all your friends can live nearby. You and all your rich friends can live on the millionaire's row, I guess, of Kansas City. Before we get started, definitely like and subscribe, and make sure you hit the bell so you don't miss out on any future content. I make videos like this as well as individual stock reviews every single week, so you don't want to miss out on any of those. Welcome to the Portfolio Bulletin. Let's get started. So the Dow climbed into the second quarter of this year, starting off with a positive note. So there were some modest gains to start off the quarter. Across all of the major indices, you can see S&Ps, QQQs, as well as the Dow all up just a little bit to start the quarter. And you could definitely attribute this to the fact that the U.S. West Texas Intermediate oil benchmark did fall below $100 per barrel because the Biden administration pledged to release some of the oil strategic reserves from the federal government to help combat the pretty high prices in the oil industry right now. This is a result of the fact that Russia supplies a lot of oil to the global supply, and basically nobody's buying their oil right now because they decided to invade another sovereign country. Also, the U.S. is still adding some pretty good jobs, around 431,000, a little bit lower than estimates, but still a pretty good number, which is decent evidence that the economy is still growing. Basically restate that here, it came in weaker than expected, but not as bad as some thought that it might have been. They say job vacancies are still being filled and wage growth continues to be quite robust. You could certainly argue that this is due to inflation, and wage inflation is getting a little bit out of hand along with inflation across the economy, but nonetheless, there's still growth in the economy. Also, China is considering sharing some of its company audits with foreign investors, which caused a little bit of growth here in Chinese-based stocks that are listed in the US. For me, the main one I pay attention to there is NIO. That's a company that I do like quite a bit, but they've certainly suffered due to this rumor that China may not release the data that they need to stay listed on the US markets. Another pretty major note that kind of got swept under the rug is the fact that the yield curve did invert for the first time since 2019. And what this means is that the 2-year note is offering a higher yield than the 10-year note, which is generally the opposite of what you would expect. Usually you get paid for locking your money up for longer, but this means that investors are more concerned about the 2-year outlook than the 10-year outlook, generally signaling that there could be a recession in the short term. They say here that the inversion of the yield curve can indicate a recession, but doesn't necessarily mean that it will happen, and history shows that it could be more than a year or longer away. They say the bank stocks struggled because of the yield curve inverting, and then they mention AMD here, which dropped around 1% amid growing concerns of personal computer demand. I will address this in a later video as AMD is one of my favorite companies that I do like to watch and trade. They mentioned that the first quarter this year was negative for all of the major indices, with the Nasdaq down around 9%, and the Dow down 4.6%, and the S&Ps down almost 5%. And the last thing they mention here is that the Fed finally started raising rates to help combat the high inflation that we've experienced despite the ongoing war in the Ukraine. To me, what this means is the economy is pretty mixed. Jobs are still growing, but the war in Ukraine is affecting the markets, inflation is still high, and rates are continuing to rise. This chart here actually kind of represents that pretty well. Things are a little bit worse than they were before, but they're not tumbling down all the way into a full-blown correction or recession. We had a little bit of a bounce into the beginning of this quarter. Moving on to my investments, you can see Worthy Capital. I did decrease this account down to $5,000, and since then it grew by $9 since I did that withdrawal, and I'm planning to just leave this alone here. So because inflation is so high, over 6 or 7% now, Worthy Bonds is losing a little bit of value compared to inflation, but it's still doing better than any savings accounts that you can get right now. So I definitely think this is a good piece of your portfolio, especially if you're keeping a lot of money in a savings account, which is currently well underperforming inflation. Of course, if you don't have a Worthy Bonds portfolio, I will put a link in the description that gets you one free bond when you fund that account. Next up is Groundfloor. This is a platform that I actually started pretty recently, but I've been moving almost all of my money from Lending Club into Groundfloor since that platform closed, and you can't reinvest any money there, so I've been moving it all over to here. You can see it's up to just over $8,000 now, and I've made a little bit over $200 here. And once all of these notes pay back, I should have a little bit over $440 in gains. And of course, I'll continue to reinvest this money as I go. Currently, I'm invested in 305 notes with an expected return of just over 10%, which is still a pretty good return even with inflation being as high as it is. You can see here my expected rate was 9.8% on these first group of notes, and my actual return was 10%, so they are somehow overpaying the expected returns, which is good. That means I'm getting the money that I expect to make, and so far I haven't lost any money. You can see my investment breakdown here. The vast majority of my money is in these C notes, with a couple in E and D with a little bit higher percentage, nothing in A, and then a few here in B. I do want to talk about the invest piece just a little bit here. Basically, I've been going off of valuation. If the AVR is a pretty high percentage, that means they're taking a pretty high percentage of the expected value in terms of the loan, meaning that if they were to default, it might be a little bit harder to get that money back. So I start with these lower percentages. You can see here some of the notes that I actually invested in around this 60, not much higher than 70% here, almost up to 70. You can see right here, 69.97. Nothing over 70 right now in terms of notes that I've invested in, meaning that the total loan value is less than 3/4 of what they can expect to sell it for on the open market. I think this is a decent way to protect my holdings and my capital. So far, it's worked out. So if you like this platform, again, there's a link in the description, and that's how I've currently been doing investing with Groundfloor. Moving over here to Fundrise. This is one of my biggest investments here at just over $52,000. Current net returns are just over $10,000, which is pretty good. And you can see so far this year, almost $1,400 and all-time that $10,000 number. You should note that they are making a second interval fund where they are consolidating 6 of their income-focused REITs into a single interval fund. And I've talked about interval funds before, so definitely check out those videos if you haven't seen them. But basically, this gives you better access to your money and allows them to be more efficient with how they handle investor capital in terms of the kind of returns that they can offer. They also released their second monthly podcast where they talk about their strategy and what they expect from Fundrise going forward. I already listened to it, and it is very good. It helps you understand exactly what the CEO is thinking going forward with Fundrise. I continue to add pretty aggressively to this account, and I really like this platform. Again, if you are not invested with Fundrise, definitely check it out, and there is a link in the description that gets your advisory fees waived for the first 90 days. And even if you don't use that, the advisory fees are not very high. You can see I've only paid $60 overall on $10,000 worth of gains, so definitely worth it. Moving on to my TSP account, I still put 5% of my income into my retirement account every single month here. And for a little refresher, the C fund is the S&P 500, the S fund is the total stock market, F is bonds, and G is government bonds. You can see my current distribution is pretty close to 50% S&P 500, 40% stock, and the other 10% is split up between government bonds and corporate bonds. Currently, I'm not buying any more bonds here. I'm just buying the C and S funds, and so far I'm sitting at around $88,000. Over the past 12 months, I've only gained 4% in this account, and that's because the stock market has been pretty rough here recently. And another major reason that I contribute here, which you should always max out, is my employer gives me a 5% match, so I obviously take full advantage of that 5%. Moving over here to M1 Finance, I should note that I closed out my Retire account. If you've been following this series for a while, I had a Retire account with M1, and I have since closed that out. I moved all of that money into other places, and I started adding to my higher yield savings again, and I also added some holdings here. So this is my buy and hold portfolio in a taxable account with M1 Finance. And the change to my thesis here is that I'm not doing very much stock picking at all. I have mostly indices in here now. Except for real estate, I do hold a couple of individual real estate companies that I like, as well as Vanguard Real Estate ETF and the Fidelity Real Estate ETF, which have both done pretty well, basically identical to each other. But otherwise, I have a couple of individual stocks in here that I like. And then I do have a little stock portfolio here. This is mainly to get the benefits from these companies that they offer for their credit card. They offer 5% cash back for these companies in terms of oil. So if you buy gas from these companies, you can get 5% cash back. And then Peloton, they offer 10% back, 5% at most of these companies, to include Starbucks, Domino's, and Chipotle, and decent returns at Costco, Dollar General, Amazon, and Walmart. So these are companies on their list where they offer pretty good returns on every dollar spent on their credit card, and they're not bad companies to own. They're definitely places that I shop at least occasionally, and you don't have to have large positions. You can see most of these are very small. This oil holding is not even $10 altogether. And because of that, I still get 5% cash back on all of the gas that I buy there. Definitely a great perk of M1 Finance and their credit card. Again, another reason that I really like this platform. And I didn't want to close out all of my holdings here with M1 because I do really like their borrow feature, which allows you to get some pretty cheap cash loans, which are collateralized by your stock holdings with the company. Another stock that I did add here was Vanguard Growth. So everything else here is dividend appreciation or value. Pretty stable picks. You could argue that the international dividend select is a little bit more volatile, but definitely overall, Vanguard Growth ETF is going to be the most volatile in this portfolio. And that's why it stays here pretty low at 9%. Everything else in this portfolio is pretty stable comparatively. And that allows this to be, again, basically a higher yield savings and my third level of reserve capital if I need any money for emergencies. Lastly here, I do have my options portfolio. I did close Robinhood, so I no longer maintain a Robinhood account. I moved all of that money over into Tastyworks just to help simplify my portfolio for tax reasons and just for my own peace of mind. I also do appreciate the fact that Tastyworks does offer pretty decent margin. So you can see here, I currently have a naked put option on the Qs, which in theory would require me to buy $36,000 worth of the Qs. But I can do this and still have $50,000 worth of option buying power and $100,000 of stock buying power while maintaining only a $57,000 account. So margin that they offer is pretty good. And then I have my Roth IRA here at $24,000, which currently owns 100 shares of IWM, which I sold a put option to get into. If you want to know more about my strategy here in these accounts, I do videos about this account more in depth and how I look at these and how I enter and manage these positions, but that's a video for another time. I almost forgot to do my monthly tracker, and you can see here I actually skipped 2 months because I was really busy with my job and unable to do videos during that time. But you can see the major changes here. The stock market continued down and I sold some stocks, and I moved some of that money into my trading accounts as well as real estate. But besides that, bonds went down a little bit. Lending Club continues to taper off pretty strongly. And then we have cash, basically flat, a little bit higher than I want it to be right now, but not too bad. And you can see my actual net here is about the same as it was in December, down a little bit week over week, with 2 January being the highest value total, with 4 December, 30 January, and 2 April being all around the same total invested dollars. Definitely comment down below if you have any thoughts on anything that I covered or any of these investing platforms. And again, if you have not invested with any of these companies, definitely check the description to make sure you get your free stuff if you choose to open an account with them. Like and subscribe if you got any value out of this video, and make sure you hit the bell so you don't miss out on any future videos. Of course, none of this is financial advice. This is all for entertainment purposes. And with that, let's get to today's jelly. Today's jelly is Jack Daniel's Single Barrel Proof. So I recently just got into whiskeys, and over the past few months, I've tried a couple of different variations, and this is my first barrel proof that I purchased. And you can see here, if you know anything about whiskey, it needs to be over 80 proof. And these are sold anywhere from 125 to 140 proof, making this a very high proof whiskey with a lot of bold flavors. But amazingly, it goes down very smooth and with just a little bit of burn to remind you that it is a whiskey. I have to say it is very good and not too bad at $60 in my local area in terms of pricing. Very, very good flavors, not too much burn. Can't say enough good things about it. Definitely check it out if you like whiskeys. However, I will say it is not a great whiskey to start off with, because it is still pretty high proof compared to most other basic whiskeys. Definitely comment down below what you think of this whiskey or any others that I should try in my journey in exploring whiskeys. Just started a few months ago, as I mentioned, so let me know down in the comments what you think is worth trying. Definitely like and subscribe before you go, and have a great day. Otherwise, like and subscribe before you go, and have a great day.